I don't know if it's a tale of many cities. I don't know what we're even looking at here, but you want to talk Microsoft Alphabet, you want to talk Boeing. Some looks good, some looks bad. We're going to have Meta this afternoon. What are you thinking about?
Yeah. Well, let's start with Boeing. That number, obviously, the headline miss and the bottom line miss as well. But we don't really care about that, to be honest with you, Andrew. We care about cash flow. Free cash flow was negative $180 million, but the expectations were for $900 million negative. So this was much better than expected. Operating cash flow also was better than expected. And the fact that they didn't have to take another charge for the 737 MAX or the 787 MAX or any kind of 787, the regular airline, that all of it is very positive in kind of making progress, if you will. So the backlog of $372 billion is huge, 4,200 planes. I mean, so this story is on its way. It's still down quite a bit this year, quite a bit the last couple of years. But I do think that it can be bought. I think that the next catalyst is going to get the 787 back into production and then delivered, and then the 737 MAX certified for China. So that's Boeing. You want to go to Google? You want to go to Microsoft?
Let's go Google, Alphabet. Yeah, let's do it. The thing that I can't figure out, though, is are we now in a situation with all of these stocks, and you're seeing them many of them do a lot better. Is it just because the expectations were so bad? Is that the issue?
Well, yeah, I mean, look, Alphabet is down 27%, Microsoft's down 25%, Boeing's down 20%. Boeing is a turnaround story, so that's kind of different, right? They just need to make progress and have no charges and have good cash flow. Alphabet, actually, I thought the numbers were pretty good. And then when you go through all the details, actually the EBITDA is going higher by 4% this year and 3% next year. So I get why the stock is up, right? And it's kind of like a sigh of relief. There are still a lot of uncertainties, though, right? I mean, the global macro, they talked about tough comparisons. And then travel search is 10%. Travel is 10% of paid search. And so we have to keep an eye on that. But guess what? The ad revenue number was 5% better than expected, better than feared. So, yeah, like it is a sigh of relief. Are we in the all clear? I don't think so.
Stephanie, can you explain this to me? You saw the Visa numbers, but also I would say the Visa commentary, which seemed to suggest that the consumer is holding up just fine. And I don't understand how that can be the case if you then look at the Walmart numbers. And by the way, then even just look at some of these ad numbers because of the worries that those businesses have about spending money to advertise.
Well, the consumer has changed what they're buying, right? We've gone from goods to services, right? So think about this. I mean, again, Google Travel was fine. Let's look at what Hilton just said. I mean, they just beat and raised. Wyndham Resorts also just beat and raised. So people are going out and doing things. Do you think it's sustainable? That's the biggest question, right? Because
what do you think?
I believe that they will. I do think they will. I think that there's a lot of pent-up demand. I don't think the consumer is in such dire straits. I think there are pockets of the consumer, the low end, that are seeing a real challenge time. I think the high end is doing okay. I think Walmart and Target just messed up, quite frankly. They didn't see the trends going from goods to services, right? I mean, Brian Cornell said they're not buying apparel, but they're buying suntan lotion and luggage, right? So they had so much inventory on the good side of things, and they'll get through it. And by the way, it's really great that they're going to mark down things for the consumer, and the consumer will buy those goods at a lower price, and that's also positive.
Steph, we got to run, but final question to you. As a value investor, we got Meta coming up this afternoon, and Meta stock, as you know, has just, I mean, I don't want to say collapsed, but practically. do you look at that and say, this is a value play, I kind of like it? Or do you say, oh, my goodness, this is a falling knife?
Well, it is sort of a falling knife, but it's down 52%, and it trades at 13 times earnings and 7 times EBITDA. It is profitable. They generate a ton of cash, and they're buying back their stock. Okay, that's all the value side of things. But it's all going to come back to engagement, and we'll have to see time hours spent, right? And there's a lot of competition, we know, but isn't that already factored into the valuation? That's the way I view it.